strategies, market screen, and maybe one or two questions from your side directly answered in our webinar. Our goal is quick and smart, but for that daily. So let's have a nice start like every day. And like every day, we will start with our risk disclaimer. Forex and CFDs are leveraged products and can result in losses that exceed your deposits. If you're a starter, please start with a demo account and make yourself familiar with long trading, short trading, leverage trading, and your personal risk management. If you'd like to read the full risk disclaimer, just visit one of our web pages, for example, atmermarkets.com, and you will find everything written down there. This is our scheme. On Monday, like today, it's Jay's day. On Tuesday, it's Paul's day. On Wednesday, it's Giancarlo's day. On Thursday, it's Marco's day. And on Friday, it's Dirk's day, our leading day traders live every business day to the same time. This is me. My name is Jens. I'm the German guy from Atmer Markets. We are a big international broker, over 18 country offices. So my English is made in Germany, but maybe some of my quality too. But I'm not the main speaker. The main speaker is the day trader of today. And of course, if you like to trade Forex and CFDs, you will get many benefits only with us. For example, DAX 30, one of our bestseller, typical spread of just 0.8 points during the main trading hours. Check all the other details out on atmermarkets.com. There you will find also how to contact us. You can call us, you can send us an email, or visit the other channels like YouTube or Facebook. Everything linked from atmermarkets.com. There you will find also information about our regulatory background. And yeah, enough from my side. Now it's time for the day trader of today. Good morning, Jay.
Die Stummschaltung ist aufgehoben.
Hey, good morning, traders. Happy to have you all here. I hope you had a wonderful weekend. We were working quite hard. We actually had an institutional options trading course. Good morning, Eugen. Good morning, Jörg. Good morning, Andrea, and some of my other traders, as well as all to the guests and to Berlin. Hello, Jens. All right, let's get started. We had some headlines over the weekend. Current picture out of Asia was that we had a mixed risk picture. So there's no clear risk on. There's no clear risk off. I hope you can hear me well, by the way. Can you hear me okay? Everything all right?
Everything clear and fine.
Okay, awesome. So let's rock and roll. Erdogan, my friend over in Turkey, I'm being sarcastic, wins the presidential election with over 43% of the vote. So there's no second round needed. He is in, done and dusted, new presidential system. Got rid of the prime minister position a few months ago, and he is the lead guy right now. So we're seeing a decrease, another country with a decrease in democracy around the globe. Very interesting for us to observe from a big picture macro perspective. The Turkish lira strengthens over 2% on the back of it because the expectation is that he will now comment on rates next, the rate environment. Recall that he directly interfered with the central bank, and a central bank is supposed to be politically independent, and the governor of the central bank had some severe issues hiking rates in order to stem the inflationary pressure from a decreasing and depreciating Turkish lira. Nevertheless, some of this strength in the Turkish lira was already priced out during the London session. Also relevant, on July 5, the People's Bank of China is going to cut their reserve requirement rate and ratio by another 50 basis points. So this is expansionary, which is supportive of the economy. This is a form of monetary easing, which would induce a risk-on scenario out of Asia in terms of equities. Unfortunately, Trump was at it again via Twitter, and Friday, as well as over the weekend, is increasing the strength of his rhetoric in regards to trade wars and trade sanctions. So right now he's talking about restricting tech exports to China and restricting Chinese investments in the US. Any company owned by more than 25% of Chinese ownership is restricted going forward, or that is his plan to invest and merge with companies in the US. He's intending to use a law from 1977 in the US to get that through. Unfortunately, that is causing some risk off in the world. The thing that is troubling is that we have these trade wars looming over us, and since they're being fought on Twitter and via whoever hits the mic and gives a negative comment, It's very unclear. And what the market has is uncertainty. Markets just do not like uncertainty, and hence we're seeing a mixed risk picture. Then on Friday and over the weekend, we had OPEC plus, that means Russia and countries not officially part of the OPEC agreeing to raise their output, because output due to Iran sanctions decreased and Venezuela not getting their shit together, and there's a lot of problems in the system. So OPEC, especially Saudi Arabia, they have the largest slack, the largest resources. They can actually step up, increase production, and make up for the shortfall of the alluded to countries. Lots of uncertainty, and the statement actually did not give the exact barrels per day number that they're going to increase oil production. But a number as high as 1.8 million barrels per day of an increase was touted in the market. And what actually came out of it is a number closer to anywhere between 600,000 and 800,000 barrels per day. So again, less than expected. The magic word is always expected, because the professionals trade expectations and not what is. Anything in 6 to 18 months down the road is what we're betting on with billions of dollars today. So that means less than expected in terms of increased supply, and oil rallied. Brent came off. Some of this rally was already priced out, and similar to WTI. As I look over, let me have a quick look. WTI trading around 68.92 right now. All right. Oh, actually we're rallying again. So here we go. I stand corrected. We're heading into or towards 70 once more. Hong Kong money market rates hitting a 10-year high. Hong Kong, the currency is pegged to the US dollar. The Fed is raising rates, so the Hong Kong Monetary Authority has to do the same. Watch this closely. If their currency reserves were to fall ever below 50 billion, the peg would be probably dissolved. Any one of you who got caught in the crossfires with euro versus Swiss franc pegged recalls that trading a pegged currency can be at your own risk and peril, quite dangerous. So the fact that the rates are increasing in Hong Kong, which is a very small economy, shows us that the equities reacted negatively to it. And that is basically the big picture over the next couple of years for US equities as well. As the rates are increasing, that puts pressure on equities, and we need to keep that in the back of our mind. Bank of Japan, we had the summary of opinions from their last monetary meeting, which was June 14 through 15. And as you may know, inflation is a long way from their target, which is 2%, a long, long way. But they basically reiterated that they're going to continue to print money, fix the 10-year yields all the way from 0 to 10 yields at nil, 10-year rates at 0%. And this was important because across the globe, we saw a contraction in economic growth in the first quarter. And in the UK, they said, hey, this is due to bad weather, and the numbers actually started to pick up again. And it's a similar picture in Japan. In the summary of opinions, they basically mentioned, yes, we had the first contraction in the March quarter of 2018, and it was the first contraction in 9 quarters, but we think it was due to temporary effects like irregular weather. So there you go. Now we need to predict the weather. I'm just kidding. Then we have this week's EU summit, and that may be of importance to Merkel because her coalition is under threat. I don't know any of you out of the UK or US or wherever you're dialing in from know about German politics, but we have a grand coalition once again, useless, and Merkel opened up the borders, and people migrating into Germany, not only refugees but also economic refugees. The CSU has a vote coming up out of the state of Bavaria, one of the richest, largest, most important states in Germany, and the CSU is losing votes towards the AfD, which is a far-right party, anti-immigration party, very similar to what we saw in Italy, right? So we have anti-immigration parties gaining in popularity amongst populations across Europe. Why? Because it's a complete clusterfuck, this whole migration issue. Nobody's in control of it. It's completely erratic. The ministry in Germany was supposed to be in charge, and it's underwater. People get fired. People may go to jail. It's amazing. And Merkel, and this is the more amazing part, just says, I'm keeping the borders open. Everything remains as was, and people are a larger part of the population, and this is expressed via the CSU trying to fight for votes in Bavaria. Are starting to run a hard line against her. So we need to keep this on the radar, because if this actually escalates, and the largest coalition partner SPD in Germany already started preparing for a new vote over the weekend, at least that came out in the headlines, that means there could be some euro pressure. Because the thing that Europe can't really, in terms of an investor perspective, use right now is for Germany to be in political turmoil. And then let's recall real quick our open positions and trades that we did. We had a while back, end of May, we had this long euro Canadian dollar. Then we had this long Aussie dollar, and we had this euro yen loss. That was the last trade. For me personally, it wasn't a loss. Why? Because I saw that we can't rise over the swing high. So if you can't hit into it, and we actually said, you need to watch the video again from 2 weeks prior, we said we are long euro yen into the ECB, and then there's so much positivity priced into the euro, there's basically nothing that Mario Draghi and his team can say that would have benefited the euro, and there would have been we would have seen upside in the euro. There was really nothing he could have said. There was so much positivity priced into this euro move that we said long into the ECB, and ahead of the ECB, you either short or you flatten your position. So let's watch that again. Overnight, we had, as you can see, some risk off. Lower left-hand side, the yen strengthened, and we saw also some pound weakness. Pound, there's a lot of headlines hitting the tape currently. Why? Because the October Brexit deadline is probably going to be missed. Highly, highly probable. There will be a technical extension to that, and it's getting very, very complicated. On a weekly basis, we need to read up on who's voting on what is the current issue. Quite exhausting, to tell you the truth. In terms of numbers, the IFO came in a little bit weaker at 101.8. It's not on here because it hit the tape while I was preparing the slides. Then on Wednesday, we have New Zealand dollar trade balance, and that is expected to come in weaker. That would weaken the New Zealand dollar. Then we have Carney speaking and the Bank of England Financial Stability Report. I recall last year that came in much more hawkish than expected, and the pound rallied like crazy. So keep this on the radar. I know that there is no forecast for it. You need to be aware of it. You need to be aware of it. And if you're a day trader, spend some time in front of the screens. Last time there was a massive reaccumulation, super opportunity to buy. Out of the US, we have durable goods, also expected to come in weaker than expected on the core side. So that's not that positive. And then we have the rate statement and official rate announcement out of New Zealand. So there's some weakness expected ahead of it. And for the rate statement, inside of the statement, there may be, in terms of wording, a little bit more hawkishness. That's what the market expects right now. So my feel for it is weakness into the statement and then a potential rally. Okay, so have a look if you can short the New Zealand into the rate statement and then a hawkish reaction potentially off of the back of it. And then German preliminary CPI numbers on Thursday, as you can see, also weaker than last time expected. The economic summit, we talked about that. Out of the US, the final GDP. Please recall there are always 3 readings, and the final is the one with the least impact. It's basically already baked into the price. Nevertheless, we keep an eye on it in case there is a larger revision. Then on the pound, we have the current account side, final GDP as well, and net lending to individuals. Bank of England is also data dependent. For the July meeting, nothing that much in the making. The August meeting is the next one where we're eager to see if they're going to hike again. Recall last meeting, there was one additional dissenter, We had McCafferty, Saunders, and now the head economist out of the Bank of England also dissented, and that saw an immediately strength in the pound because the vote was expected to come in at 2.0 and it came in at 3.06, and that had a hawkish reaction on the back of it. See how easy this is once you understand what the fundamentals are. Forex trading really, in my personal opinion, is the fastest and easiest way to generate weekly gains. But that's just my opinion. All right, CPI out of the euro area, slightly higher, but then on the core side, slightly weaker. So a mixed picture on CPI. And one of my traders went over it over the weekend with me, and she told me, keep an eye on it. We do see globally PPI increasing. And if PPI increases, that means inflationary pressures. And most of this PPI strength in terms of rising prices is passed on to the consumers. Canada, we have the GDP and the RMPI, and no forecasts for those, but we need to be aware of that. And then core PCE is the favorite indicator for the Federal Reserve in terms of inflation gauge, which is, we already know that, currently underperforming the CPI figure, and the Fed said we're happy to overshoot on inflation. So do not expect such strong of a reaction as we normally would to a deviation, in case there is a deviation, just because the Fed said, hey, we're cool with higher inflation for now. And then important for the Aussie dollar, we have manufacturing and non-manufacturing PMI numbers out of China that are expected to come close to how they came last time. Aussie dollar, lots of weakness right now. Why? Because it is a carry currency, and the largest rate or the highest rate that we can get currently out of the G8 is in the US. And so there's a lot of carry flows that are going out of the Aussie dollar into the US dollar. Then there is a high correlation to equities. So when equities sell off globally, the Aussie dollar sells off. And then copper was also selling off quite significantly. It's rebounding right now a little bit, but the copper sell-off due to an expectation of less demand out of China also had some impact in terms of weakening the Aussie dollar. All right, so I'm trying to be quick. It's just one slide today. CPI numbers mixed, close to the 2% target. Important for us to recall that the net asset purchase program out of the ECB is ending end of this year. December is the last time. It was reduced from 30 billion per month to 15 billion per month, but reinvestments will stay in full effect. So that is still expansionary. If they would say we're shrinking the balance sheet, similar to what the Fed does, that would have been stepping on the brakes. But reinvestment is full in effect. And the first hike is not expected out of the ECB until summer, more likely autumn 2019. We just had an ECB speaker on the tape that guided towards autumn 2019. This is the process. This is what central banks do. They guide people, they guide the market, they guide investors via having one of the members hit the mic and give statements. And then the central bank watches the reaction in the market and then can gauge if their communication with the market participants is in line and functioning the way that they want it to function. So the market is really not expecting any significant move to inflation numbers right now, because ECB said, hey, we're cool. So in summary, we have the Fed hiking. We have the Bank of Japan easing, and the differentiating on the margin differentiator is the ECB. If the ECB tightens, global yields will rise. If the ECB continues to ease, global yields will stay in check. If ECB tightens, we have a situation that will have a global impact on growth. We need to be aware of that. So always need to know in terms of who's the most important central bank currently. The number one is always really, in reality, the People's Bank of China. A lot of people don't know that. Then it's the Fed, and currently the main focus is on the ECB because they decide more left or right, easing or tightening globally. Core PCE, we talked about that. The year-on-year figure is to remain at 1.8. So that's inside of 2%, which is their target. And the Fed said overshoot is cool. I know that I'm repeating it, but you need to know these things inside out. Some weakness expected on Wednesday due to trade balance for the kiwi, and then no change. The rates are expected to remain at 1.75%, which is less than the 1.75 to 2% out of the Fed. Okay, there's another carry currency next to the Aussie dollar that is seeing global outflows due to the fact that you can get more carry out of the dollar. Expectation for similar communication that rates will remain on hold for some time. And now comes a funny bit. We always have a funny bit. The wording. When central banks speak, the market really goes word by word. What do they say? And in the last communication, they used the words up or down when they describe future rates. Couldn't go up or down. So the market is super ultra focused on what are they going to say now? Up or down? Are they changing the wording? But overall, market expects no change by the bank in terms of their outlook for their OCR, official cash rate. Okay. All right, and then the press release may be slightly more hawkish. That is what recent research suggests than the May statement. So weakness into the meeting, potential hawkish reaction after the meeting. I hope I'm explaining it all slow and sound so that you understand it. Commitment of traders report, Aussie dollar was on the way to a long, then a long signal. It was a false signal. Now it's on its way to a long signal. Why? Naturally, because of what I just explained twice. Higher rates in the US, money moves out of the Aussie dollar into the US. It's on the margin, and that's what's moving the market. It's always what's happening on the margin. Swiss franc, long signal. And you'll see that in our trade for the day or for the week in a bit. Kiwi on its way to a long signal. Volatility. I missed last week because I was teaching. So this week we need to compare to 2 weeks back, but we see Euro vol came off a little bit, Pound vol came off a little bit, Yen vol came off a little bit, and the VIX actually increased slightly a little bit. Equities seasonally over the summer, there's logical explanations due to less liquidity over the summer, tend to sell off a bit. So if you see a good signal, depending on how and what you trade for long volatility, I happen to agree with you currently. I think if the trade wars start to escalate, even if it's just for a bit, volatility is so low around 12 that I think it can jump and that can make you some money long vol. It's a very expensive carry trade. You have negative carry long vol, so you need to be careful on that. Option pricing bullish this morning, pound versus dollar, i.e. cable, and bearish euro dollar, euro yen, and euro Swissy. And in terms of what we saw out of the option flows, indication for the London session, bullish Aussie, Canadian dollar, yen, Swissy, and gold. So this is risk off. This all says risk off, right? And this bullish Aussie, Canadian dollar is bogus at the moment. And then bearish Monday London session, pound and euro. And that leads us to, and here you can see, by the way, do you see this red bit? Just a tiny little bit of red right here. That is the positioning for the US dollar out of the large specs, and the speculator positioning went from net short to net long. So that's interesting. So the potential trade for this week that I keep on the radar is short euro Swissy. We don't really have tier 1 data out of Europe for this week, but we do have that summit and we do have that threat over the German coalition. I'm not trying to build up a scare. I'm just saying we have it on the radar. So slightly weaker economic data and positioning is weak. Why? Because we're seeing an increase in longs for the US dollar. That means other currencies are weakening based on these currency flows. And then for the Swissy, we have a clear cut signal long. And then we have risk-off sentiment, which may become probable due to a trade war escalation. But the structure of the trade, two sell limit orders, average 1 daily ATR in terms of stop loss. And then the risk for the trade is obviously that we do turn in terms of sentiment towards risk on. And then we would see Swissy outflows. Also in terms of the Swiss franc, the SNB the Swiss National Bank, the Central Bank for Switzerland. Jordan said recently that the Swiss franc's strength is not to their liking and they actively intervene. We always need to keep this in the back of our minds when we trade the Swissy long. And then we have positive economic numbers and headlines for the euro, especially summit headlines. If that were to be the case, then this trade would potentially get stopped out. Not to worry, because we only really trade 1% of risk max for each position. And then this is the structure, this time out of a 4-hour chart. We currently see that we're around fair value, not really much to do. If you're very, very bearish, you could sell fair value. I'm not. I'm looking for liquidity above me. And then this is the target. Guys, I know it was probably a little bit longer today. I don't know how much time did we spend. Can't see it right now. It doesn't matter. I hope you got something out of it. And I wish you a very successful week. Make a lot of money, hopefully. Not that much on the docket, so there should be some good technical trades too. Remember, volume leads the way. Thanks for showing up, and I wish you a great week, and I'll see you next week. And thanks to you as well, Jens, as always.
Thank you, Jay. Tomorrow is another day. Tomorrow is a day where there will be Paul, so hope to see you all again. And if you like, today at 6 o'clock German time, or 5 o'clock London time, or 7 o'clock Eastern European time, wherever you are, a new webinar with Jens Klatt, also a new moderator for us. If you like, and live in the webinar, I send you the link. If you are not live in the webinar and watching our YouTube video, just go on altmanmarkets.com. In the webinar section, you can register there. Thanks a lot. Maybe we see us again at 6 o'clock German time with Jens Klatt, and if not, tomorrow another day with Paul. Bye-bye.